January 2, 2012. Real Estate Capital Scoreboard January 2012. January 2, 2012, Chicago, Illinois. The new year looks brighter for the real estate capital markets, given the continued momentum of the past 2 years. Numerous favorable signs are emerging, including inflation concerns resurfacing, giving the Fed space to boost the economy. However, Treasury rates remain low, moving up only about 10 basis points during the past month. Inflation levels of 2 to 3% for this year should prove to be acceptable. Industrial markets improving nationally, particularly on the West Coast and major Midwest markets, led by electrical, automotive and metal fabrication. Retailing sector maintaining discipline by keeping stingy inventory levels even after an improved holiday season, as consumer spending still in flux. Suburban office market vacancies dropping, although few landlords report any improved profitability levels, clearly a tenant's market. Housing construction starts will boast positive results as energy states in the Midwest and the South/Southwest grow, while more overpriced areas pause, bringing more buyers into the ownership pool. Housing affordability benchmarks have substantially improved, with home prices now often below a 3-to-1 ratio of price to income, a dramatic reversal from the pre-Great Recession housing pricing. At such levels, more housing will be sold as lenders continue to unload foreclosed homes. New construction starts are still limited to multifamily buildings in the major markets and some energy belt communities. Substantial concern among investors of overheated pricing pressures in relationship to home ownership impacts investor 2012 acquisition plans. Expect more cautious price appreciation. Banks seek more loan volume as the financial crisis cools down. Despite a slow start, expect more bank mergers this year. While rebuilding capital reserves, banks are cramped by limited growth as they prolong extremely conservative, restrictive lending. Ultimately, fewer banks mean less competition. After a lot of recent talk, home ownership is now starting to impact the rental market segment in some major cities. This environment provides extremely attractive pricing options for renters to become homeowners, again, suggests Gene Peck, the Real Estate Capital Institute's director. February 1, 2012. Real Estate Capital Scoreboard February 2012. Chicago, Illinois, February 1, 2012. The nation's economy is showing signs of improvement in the early part of the year, despite modest income growth and overall weak labor markets. Key trends show mixed signals, including the Fed's announcement to hold down rates over the next year is part of a continued trend for record low rates to boost the economy. During the past month, rates have steadily dropped, with overall mortgage rates falling within the 3.25% or greater range for 5-year, fixed-rate debt and starting a 4% for 10-year debt. Stubbornly low interest rates fuel core property pricing levels as never seen before. Middle to higher single-digit overall rates of return are now more acceptable for such properties' core assets. Even as interest rates are extremely low, mortgage spreads continue to tighten, with agencies leading the way by 5 basis points or more. Mortgage investor demand continues unabated. Insatiable demand for multifamily properties continues to stoke new construction pipelines to peak levels around many parts of the country, with 2014-15 seen as cautionary years of oversupply. Other than multifamily properties, a new development supply pipeline is trickling across all other segments, helping to assure a more balanced supply-demand recovery even in the face of a slowing economy. Office markets still crippled, while industrial properties are modestly improving. Investors return to these two sectors as yields are more attractive and most see the markets have bottomed out in the foreseeable future. Productivity gains drive investors to look for smart versus lower-priced commodity space. The retail sector is modestly returning, despite historically high vacancies. Limited new supply and weak demand. Limited new supply with selective demand assures a delicate balance of modest rent growth supported by a limited recovery. With value as the buzzword in the industry, retailers are crossing into different sectors, creating more consumer confusion. Malls are offering discount merchandise. Overall real estate capital pricing viewed as a good relative value as compared to stocks and bonds. Secondary markets offer more attractive yields, but investor interest is still tepid as job growth and economic uncertainty leave many markets behind the hotter coastal areas. According to Gene Peck of the Real Estate Capital Institute, mortgage rates continue to be the salvation of most cash-flowing transactions. If projects don't pencil out at such low rates, little or no hope remains for such assets.
March 1, 2012. Real Estate Capital Scoreboard March 2012. Chicago, Illinois, March 1, 2012. As the second quarter approaches, the real estate capital markets are nearly back to conditions that are more normal. Lenders are saddled with ample cash and many have cleaned their balance sheets, now looking for fresh new funding opportunities. General mortgage market conditions are outlined as follows. Mortgage rates, 3.85%, for very low leverage, to 4.75% for up to 65% leverage is a typical range for 10-year loans offered by life companies. 5% is a rough benchmark for where CMBS and higher leverage life companies are actively competing. 9 to 12% mezzanine and preferred equity funds available for funding debt above standard levels. Loan amounts and leverage, $8 million or more is a starting loan amount for capturing the most competitive funds. Smaller loans offered at pricing premiums of 25 basis points or more. 75% leverage is available from multiple sources for the highest quality retail and industrial properties, 65% to 70% is a benchmark for office properties. 80% is the maximum leverage for apartments based on CMBS and agency execution. With mezzanine financing, leverage levels approaching 90% are available for projects with ample cash flow. Underwriting, an overall debt yield of 9% to 11% applies for securitized loans, although the trend is to use rating agency LTV as a new benchmark. Debt service coverage ratios are much less relevant as interest rates are extremely low. Depending upon the lender, the cash-out discussions may be a factor, but more funding sources are becoming more liberal on this issue. Agencies are the most effective at lowest pricing with highest leverage. Life insurance companies are the price leaders, particularly for low leverage and flexible documentation. CMBS players returned, mostly picking off commercial properties in secondary markets or with projects seeking higher leverage. Observations: lenders' biggest concerns remain for finding projects that have sufficient cash flow. Again, rates are the lowest in modern history with 6% approaching high-risk pricing. A couple years ago, such rate would have been available to the highest quality projects. The Real Estate Capital Institute's Gene Peck notes, nearly every property sector is gradually recovering. For example, office buildings are now financeable with lower overall occupancy levels of 70 to 80% being more acceptable. In contrast, 90% was a benchmark for much of the past decade. April 1, 2012. Real Estate Capital Scoreboard April, 2012. Chicago, Illinois, April 1, 2012. Continued signs of economic improvement bode well for real estate capital markets. The number of lenders entering the marketplace is sprouting as fast as record temperatures have been rising during this spring season. Hot market trends include: no doubt, apartments are the poster children of commercial realty markets. Well over 10% growth in new construction starts exists within this sector as vacancy rates remain in the 5% range nationally. Over $30 billion of securitized mortgage bonds is expected to be issued this year, a mild improvement over last year. CMBS volume will still be only about 10% to 15% of the peak volume witnessed 5 years earlier. Overbuilding concerns might surface within 2 years or so, in tandem with new supply and recovering housing markets. As core and core plus assets reach stratospheric prices, investors are moving into lower-tier properties and to secondary markets for greater value/yield plays. They still favor core properties as inflation hedges, given improving office, retail and industrial leasing fundamentals. Investors are taking note of rising utility prices taking toll on cash flow performance, portending more expense increases. Rising water and power bills chip away at the bottom line. Additionally, municipal infrastructure costs creep upwards while tax revenues stay flat or decline in many areas, causing concern about future property tax bills a few years in the future. As for current pricing, while treasuries have slightly risen, mortgage spreads over treasuries continue to tighten as lenders see few alternative investments with similar yield and risk profiles when compared to the bond market. Overall, mortgage spreads over treasuries fall within the 180 to 260 basis point range for most types of institutional quality properties. Banks are particularly active for term loans of 5-year or less, while life insurance companies aggressively compete on lower leverage loans, as well as those properties that are in the process of stabilizing, for example, forward delivery loans. Floating rates are nominal, ranging from just below 3% to 5%. CMBS lenders carve out a niche in funding B and C grade assets, with rates hovering below 5% for 10-year funds based upon full leverage. Agency lenders and the FHA dominate with the lowest rates in the marketplace, but restricted to multifamily assets. 3.25% to 4.25% is the general rate range for fixed-rate debt of varying terms. Ms. Jean Peck, Research Director for at the Real Estate Capital Institute, comments, with the mortgage conduits back in the market, nearly at full swing, more competitive spreads and terms resurface in some cases between life company lenders and CMBS lenders. She adds, it's a great time to be a borrower for most types of cash-flowing properties. May 1, 2012. Real Estate Capital Scoreboard-May, 2012. Chicago, Illinois, May 1, 2012. April closed as a somewhat quiet month on the real estate capital front. Nearly all benchmark indices flattened out due to predictable news from Wall Street. In other words, no real surprises. The most significant capital market highlights include: according to the Labor Department statistics, unemployment stands at about 8% with significant job recovery prospects stalling. Furthermore, gross domestic product, a key indicator of the nation's health, rose just over 2%, weaker than expected. In conclusion, the Fed is hardly motivated to change monetary policy and change record low rates. Recent Fed policy decisions are seen as non-events by most investors. Agency lending volume for multifamily continues at a brisk pace. In order to control the overflow of business, spreads are starting to widen by at least 10 basis points. As for other lenders, for example, life companies and conduits, extremely low mortgage yields provide little incentive to pump more money into this investment sector. Rising stock market yields shift more funds into equities versus mortgages and other fixed-income investments. Thus for now, mortgage rates are as low as can be in the foreseeable future. The most exciting news on the capital front relates to banks. These institutions are now actively selling and moving loans off their balance sheets as profits have improved. Expect more seller financing as part of non-performing loan sales, although few banks are liquidating at distressed pricing. According to RECI's research director, Jean Peck, if you're not in the capital markets today and taking advantage of market liquidity, you're losing out to record low deals. She adds, although leverage amounts are more conservative, equity yields are attractive, the whole capital stack is very borrower/seller friendly. June 1, 2012. Real Estate Capital Scoreboard-June, 2012. Chicago, Illinois, June 1, 2012. The big news, of course, is another precipitous drop of Treasury rates to record low levels at the close of the month. The 10-year Treasury plummeted by more than 40 basis points during the month, settling below 1.5%. Mortgage markets continue benefiting from a weakened stock market, a recovering housing market and improved industrial output. Also, lower energy costs this past quarter continued helping to counterbalance markets' woes in the Eurozone crisis. The residential real estate markets are rebounding. Developers started more new home construction than expected, rising more than 2.5%. The recovery is sporadic and directly linked to job growth in various parts of the country. Falling to a 3-year low, the jobless rate hovers at about 8% anchored by improving fundamentals of the manufacturing sector. U.S. industrial production output in the U.S. climbed more to the highest levels since December 2010, mostly fueled by automotive demand, according to the Census Bureau. Yet economic expansion remains fragile as fewer than expected workers were hired. The Fed confirmed its low-rate policy, planning to hold a steady monetary policy through 2014. As a result, the benchmark 10-year Treasury floated below 2% all month, helping mortgage rates stay low, accompanied by relatively tight spreads. Multifamily spreads over comparable term Treasuries hover at approximately, about 15 basis points wider than a month ago, although absolute rates are low due to benchmark Treasuries. As for other commercial properties, retail and industrial properties are about 10 basis points wider than multifamily deals for lower leverage transactions of 60% or less. Office loans are priced about 20 basis points wider. Generally speaking, most long-term multifamily rates are in the 4% or less range. Commercial properties fall in the 4.25% to 4.75% range. Full leverage commercial properties are priced near 5%. Capital remains available from Wall Street, life insurance and agencies for well underwritten properties. Gene Peck of the Real Estate Capital Institute notes, multifamily continues to enjoy the best of all worlds, rising rents, lower energy costs and record low rates. But investors are concerned with new construction activity in some of the gateway markets. She suggests, on the other extreme, office property vacancies decreased to about 15%, with inconsistent but improving results.
July 2, 2012. Real Estate Capital Scoreboard-July, 2012. Chicago, Illinois, July 2, 2012. Treasury behavior continues a sideways course with the benchmark 10-year note drifting by 15 basis points during the past 30 days. The Fed's Operation Twist based upon selling shorter maturity bonds and purchasing longer bonds in full swing is part of the effort to stimulate the economy. Interest rate policies are mainly governed by the euro crisis and bank rating downgrades as well as China's interest rate cut announcements. All arrows point to reviving slowing economies throughout the world. Housing starts provide some positive news on the real estate development front with 3 months of rising construction permits and slight pricing gains. The residential real estate market is starting to recover despite the overall U.S. economic slowdown. On the other end of the spectrum, while commercial property sales volume levels are brisk, some firms report lower figures than a year ago, as buyers are cautious and sellers unload more assets into reasonably liquid markets. Additionally, buyers hunt for values outside core markets, hoping to capture more reasonable yields than in the mid-single digits. Since high-quality multifamily assets remain elusive at affordable price levels, new construction multifamily is still hot. Developers target younger renters seeking Class A quality living, rather than home ownership. The trend towards smaller units with significant amenities remains the target project profile. Not much news to report for mortgage rates. In the past month, Treasury benchmarks and mortgage spreads stayed within a very tight range. The 5- and 10-year notes moved less than 20 basis points, generally trending downward. In comparison, overall mortgage rates are nearly 1.5% lower than a year ago. Some life insurance companies are not reducing their rates as the treasuries lower, rather some are imposing floors of 4%, which is still an attractive long-term interest rate. The Real Estate Capital Institute's Gene Peck observes, everything in the debt markets points to a wait-and-see mentality for improving economic conditions. Let the moderate times roll. No reason to panic about mortgage rates in the near future. September 4, 2012. Real Estate Capital Scoreboard September 2012. Chicago, Illinois, September 4, 2012. For the most part, August was a reasonably stable as far as the real estate capital market volatility. Although the 10-year Treasury reached a record low, falling below 1.4%, near the end of July, it climbed about 0.25% through mid-August, and then dropped again in the first days of September to the same levels. While interest rates stayed relatively stable during the past month, select lenders have started to raise mortgage spreads. Most notably, FHA mortgage insurance premiums are now higher. These premiums stayed at 45 basis points for many years, and now range between 50 and 65 basis points depending upon the program. Other lenders are defending yields by issuing mortgage rate floors, as yields hover in record low territory. How many lenders plan to aggressively meet production goals during the fourth quarter 2012 will be a challenging dilemma. Expect this competition to act as a counterbalance to the floors put in place. The big news in real estate is a recovering housing market. Although uneven and totally dependent upon job growth, the housing market appears to have bottomed out. Few celebrate as massive foreclosures plague banks and homeowners alike. Yet prices rose in most markets, a bright spot of optimism. May 2012 construction starts for homes and apartments signal a comeback, providing a mild lift for 2012 economic growth. Multifamily rental housing is the flip side of the slowly recovering housing market. According to the U.S. Census Bureau, July residential permitting data for multifamily permits increased nearly 50% the national level as compared to a year earlier. While these figures are still below historical levels, look for more caution from lenders on any type of new multifamily development, as a result. Moving to the commercial property front, office property investors are re-emerging as the rents have stopped plummeting, particularly job growth areas, namely healthcare, energy and technology firms. Nevertheless, rapidly changing electronic filing and other technologies continue shrinking space needs with more productive and smaller configurations. Office sharing firms are the winners in this segment. Retail property owners continue grappling with e-commerce issues and shrinking space as well. Industrial development is moving in tandem with an improving economy. Lastly, lodging is holding its own, showing a clear separation between high-quality and low-quality assets with a dramatic variation in values. Ms. Jean Peck of the Real Estate Capital Institute predicts, the fourth quarter will be very busy on the financing side as borrowers realize the bottom is here. She suggests, mortgage rates can only go in one direction, up. October 1, 2012. Real Estate Capital Scoreboard October 2012. Chicago, Illinois, October 1, 2012. Other than improved CMBS market conditions, much of the focus within the realty capital markets leans toward Treasury behavior. Monthly highlights are as follows. The gap between life companies and CMBS debt is narrowing as Wall Street returns with a vengeance. Conduit loan spreads have tightened by as much as half a point during the past 2 months. The net effect is substantially more competition for permanent loans, particularly for terms of 7 years or longer. Banks comfortably dominate funding arena for terms of 5 years or less, including floating rate debt. Even though new construction home sales recently fell, prices posted the largest increases since before the Great Recession. Based upon job growth in select metro areas, the housing recovery is uneven, but a shortage persists for lower-priced units. Fixed-rate home mortgage again dropped to record low levels below 3.5%. Such persistently low rates seem to prove the Fed's monetary policy soundly impacts housing. Treasury rates dropped during the last half of September, proof that domestic consumer spending is slowing within a fragile economic recovery. Chinese and European economic sufferings add more such concerns. Expect rates to stay at low levels in the foreseeable future. Credit lines, letters of credit and other unsecured bank-related financial instruments are still challenging to obtain. Lenders seek strong collateral backing any type of transactions, erring on the side of caution as far as credit risk. The Real Estate Capital Institute's director, Jean Peck, opines with mortgage rates at such low levels, much of the attention is towards improving property financial performance. She adds, debt pricing for core properties is at commodity levels, meaning lenders compete on leverage and other underwriting factors beyond interest rates. November 1, 2012 Real Estate Capital Scoreboard November 2012. Chicago, Illinois, November 1, 2012. Hurricane Sandy was no lady, or a pleasant trick-or-treat surprise. The massive devastation froze the capital markets this week, with the full effects still unknown. Yet the mid-fall funding season is very active, mostly due to the resurgence of conduit lenders in the marketplace. All capital sources are forced into competitive bidding due to the CMBS reemergence. Both the November presidential election and Fed policy action reinforcing low rates until 2015 have resulted in borrowers having less urgency to refinance by year-end. The state of realty capital markets is summarized as follows. Record low rates. While treasuries climbed this past month, spreads tightened by as much as 25 to 50 basis points, depending upon the type of lender, leverage, project quality, etc. 10-year, fixed-rate permanent loans are priced regularly below 4% for lower leverage transactions, while 5-year loans approach unheard levels near the 2% mark. At the end, rates are only slightly higher than a month ago. Dropping floors. A clear result of dropping rates are lower, or no, floors. Lenders chase yields downward, eliminating floors on the way down. The 4% floor was commonplace with life companies, while CMBS lenders clung to 5% for much of the year but no more. Competitive lenders are dropping floors, in light of fierce competition from all fronts, life companies, banks, conduit and agencies. New supply, more development deals brewing, and not just multifamily. However, development is very targeted, mostly underserved in urban infill sites. In particular, multifamily with mixed-use components, parking, retail and office, grabs the spotlight due to the readily available financing for this sector. New construction office, retail and industrial deals are financeable, but with substantial equity or based upon strong credit tenant profiles. Smaller loans. As the picking gets slim for larger, quality assets, lenders are moving down the dollar size scale. Loans of $5 to $20 million gain more traction, particularly with conduit lenders. During the past few years, much of this funding turf remained in smaller LifeCo and bank territory. Equity pricing. Equity pricing closely follows declining debt costs. Generally speaking, coastal core properties are targeting overall yields in the 8% to 10% range for multifamily, office, retail and industrial properties. Value-add pricing is within the 10% to 15% range, including a wider spectrum of assets such as senior, self-storage, healthcare and lower-grade conventional properties. Last but not least, opportunity funds target appreciation versus cash flow, taking on the remainder of the commercial real estate investment base with yields of 15% to 20% or more. Ms. Jean Peck of the Real Estate Capital Institute suggests, fierce competition among lenders is quickly reducing the risk profile differential between various types of properties. She further notes, the borrower is the real winner, as lenders finally realize lower rates are here to stay for a while. December 1, 2012. Real Estate Capital Scoreboard December 2012. Chicago, Illinois, December 1, 2012. The Fed's clearly publicized intention to keep interest rates low until 2015 firmly establishes new mortgage pricing benchmarks for the next few years. Realty investors now fully realize that lower returns are here to stay within a flattened yield curve environment. Crowded competition for higher quality loans also assures that virtually no extra money is left on the table for armchair yields. Lenders must aggressively hunt for the right loan opportunities, or stay on the sidelines. Where is the low-hanging fruit in the real estate capital jungle? The answer lies in pro forma lending. Pro forma underwriting allows for more favorable funding structures, while tapping into better yield profiles. More forward-looking risk means more risk and corresponding profits. The most popular routes for pro forma loans include high-leverage debt, bridge loans and forward delivery mortgages. Bridge/transition loans. High-leverage bridge loans are a void in the market. As banks slowly re-emerge from their past lending woes, bridge lenders fill the gap for borrowers seeking maximum debt on value-add acquisitions. Funding as much as 90% of the capital stack, most bridge lenders are private debt funds willing to take such interim risk based upon yields in the high single-digit or more range. Extra origination and fees, as much as 3%, add to the juicy yields. The risk is high, but the profits are attractive and the redevelopment plans are clearly devised by proven sponsorship. Exit underwriting limited to 75% or less LTV based upon stabilized value projections and permanent loan programs available in the market for the broad loan takeout. High leverage debt. While maximum leverage is often the goal of many borrowers for improving profitability with less cash down, a number of justifiable circumstances warrant such underwriting if future economic performance is readily provable. For instance, well-located, well-conceived commercial properties are rebounding due to rising tenant demand combined with more profitable rollover. Select funding sources understand such leverage goals and can achieve additional pricing of 25 to 50 basis points premiums for climbing the capital stack to as much as 75% LTV. Forward delivery loans. Borrowers seek these early commitments from lenders to minimize uncertainty in their capital transactions execution. Lenders fear committing future funds at locked rates in case interest rates climb during the interim period. Forward deliveries are available because lenders see the benefit of capturing new construction/refinance opportunities for projects that would otherwise be unavailable at attractive pricing, for example, core multifamily, and early bite at the apple. The Real Estate Capital Institute's director, Jean Peck, notes, competition is heating up and 2013 will be a busy year given current volume levels.